If you've ever wanted to know the ins and the outs of what goes into the underwriting process and what makes the algorithm tick with banks and what determines whether or not you get approved or denied altogether, that's exactly what we're going to be diving into in this video. Now, the first piece of data that I was able to gather from some of the best business bankers across the country and some of the biggest financial institutions is that whether it's a credit union or a bank, each of them is going to have their own banking exposure limits. Now, this is the total amount of credit that the bank is willing to lend out to you, not including mortgages or vehicles. So I'll give you a real world scenario. Let's say that you go to Bank A, and Bank A down the street, their total lending exposure is $60,000. You have one card at $35,000. You have another card at $15,000. You're now at 50. The odds of that next card being at 10K or less is highly likely because you're hitting that total lending exposure that they're going to max out to you. But there's also something known as the total business credit exposure, and banks have two ways of doing this. The first way is a total exposure of $250,000 for each business account that you may have with them. And the second way is $250,000 for each person or each owner. Now, the good thing about this, though, is that if you have more than one owner, each owner is able to max out each of their limits, and that's how each credit partner is able to bring their contribution back into the business. The next secret to how banks underwrite is they're able to do tracking. Now, we were working with a small business owner who experienced this in real time. They were transitioning from a sole proprietorship over to an LLC. Now, they didn't want to lose all of the history that they had already built up with their bank when they were going to transition into, again, that LLC, because as you know, that's a brand spanking new business. You're getting a new EIN and you're now seen as a disregarded entity. So you're essentially starting from scratch. But the business banker, because they knew what the heck they were talking about, that they connected with, they were able to paper trail that, which is why that tracking is so important. And since it was going to be the same line of work, it was going to be in the same city, and it was going to be through the same merchant accounts, they were able to use the previous history that that business owner had already built over all those years on the sole prop side, and they were able to use that on the underwriting side to get them some good approvals for that brand new LLC. Now, caveat, as long as it's the same line of work, bank statements, merchant accounts for your payments collected, and or you show proof of your existing client base, this is all going to help and serve you far better. The next thing banks are looking at is they want to see how well someone knows their business model and where that capital is going to be allocated to. Because the reality is that not knowing the following is going to hurt a business owner from getting access to these credit lines. Not knowing your numbers, so this is revenue, cost of material, equipment, spending on marketing, how you acquire your customers, not having a plan in place, not being able to articulate how your business actually makes money, and not knowing where your working capital will be injected into. When the business owner starts to stutter or they don't know how to answer these questions on the fly, banks make an internal note placing this business owner as a potential risk, meaning they're going to mitigate themselves from either lending out to this business or they're going to flat out deny it altogether, which is what you want to avoid at all costs. The next thing about these algorithms is that they're information sensitive. They're all being fed the same information from multiple sources. You have EWS, you have Check System, you have Core Logic, and all of these systems, what they do is they feed into the algorithm with a collection of a couple of different things. Number one is they're getting of all the different variable names of the business owner to make sure no fraud is being committed. So if you have, let's say your last name is Irv, but then you have a junior attached to it. If you're leaving out the junior, then odds are you may be seen as someone that's not you trying to apply for the account on your behalf. But taking that a step further, even for something as small as ABC LLC, if it's ABC Limited Liability Company, physically spelled out, but on the application or when you go to open a business checking account, you put LLC, you could get denied altogether because, again, it could be seen as someone trying to apply, commit fraud on your behalf using your information. So even if it's something as minor as double checking the information, triple checking the information, I always tell our business owner clients, bring in your articles of organization, bring in your operating agreements to the bank. So that way there's no errors or anything that you can prevent. And again, right before the application is submitted or right before they go to press enter in the system, if you're maybe opening an account, have them turn the screen around, double check it, triple check it. That way you're not having to clean this mess up later on. Now, the next one up kind of surprised me because this wasn't like this the same time 2 years ago, but banks are really starting to get privy to this. And that's known as dormant accounts or zombie accounts. Here's what that means. Have you ever seen videos or have you ever seen someone talk about, hey, just deposit X amount of money into an account and the sky's the limit with how much credit you can get approved for, right? We've all seen those videos. We've all seen them. That's no longer the case with the majority of the banks that we're seeing, and this also applies to credit unions. Banks are relational. Apart from them being transactional, they're also relational. They want to partner with you as the business owner. This means, and again, from the data that I was able to gather, this means that they want to see you using the accounts. Now, I did give a little bit of pushback to the bankers and ask them, okay, well, how much exactly do we need to use in these accounts? And so the figure that they gave us is you want to make sure that you're using the account multiple times throughout the month. And so if I had to put that on an actual number, 8 to 12 times a month, that can be something as simple as putting maybe a recurring payment on a software that you use for your business. Maybe if you're covering company luncheons, putting that on maybe a debit card for your account. And don't forget, never let your account go under the threshold that's needed in order to keep the account open. So if the threshold is 500, when you start letting it go under that, you start to raise a red flag with the banks as well, which also hurts you apart from your account just being dormant the entire time. Next one up is putting unemployed versus being a business owner or independent contractor or even a gig worker. Now, whether you're applying for credit on the personal side or on the business side, the banks are always going to look at the common denominator. The common denominator is you, the business owner. You have to be able to mitigate your own risk because your business can be lined up exactly how the banks want to see it. But if you're putting on the application that you're unemployed or that you're collecting a Social Security pension or that maybe you're retired, even though you're running a business, that's not necessarily going to shake up in your best interest. So what we've noticed, again, speaking to these bankers, is that if you put that you are an independent contractor or the CEO or the founder in your business, that's going to serve you far better. But taking it to the next level, putting that you are the employee of your company is really, and again, you have to be able to prove this, of course, if you're giving yourself payroll, the whole 9 yards, right? But putting yourself as the employee on the application and then putting the name of your company, the business itself, helps create that separation between, okay, the business is its own standalone entity and the person is its standalone entity. And then that way it comes together as a nice solid application versus, again, you putting information on there that's going to be contradictory to what the business is trying to do in and of itself. Now, this is a big one right here, and the bankers actually warned about this because they're also starting to catch on to this. I'm gonna let you know more so how they underwrite this. Putting bigger numbers with your income or with the business revenues in hopes to get approved for higher credit limits actually raises a red flag with the bank altogether and can potentially get your account shut down altogether. Now, you might be wondering, Irv, how can they actually know based off of stated income how much I'm actually putting on there? I'm not showing any tax returns. And I also saw in a video somewhere that I can put whatever number I want. They're not necessarily going to verify it. And you are 100% accurate, but here's how they actually do it. Number one, you want to be 100% truthful with the numbers that you're reporting for your business. And number two, there's a complete scoring algorithm for how they're actually basing whether or not the figure that you're using in terms of revenue is going to be congruent with the business that you're applying for. They're taking a look at the industry code used for the business, the zip code that you're applying from, that's a big one, the age of the business put on the application, how the business actually generates revenue, how much cash reserves the business has in applying for that bank and at other banks. And also, they're also taking a look at the number of employees that you're putting on the application. So here's how this shakes up in a real world example. Let's say that I have a 1 to 3 year old business and I put that I'm generating, let's say $250,000 a year, but I live in a small town with right around 50,000 people. The likelihood of me remaining in business is maybe a lot shorter of a lifespan of me remaining in business because maybe I have less clients in that town. And again, the amount of money that I can maybe make in that town is going to be totally different from, again, that same business that's maybe now 8 or 9 years old, but I'm in the heart of Los Angeles. So this is why it's important of the zip code that you're using, of where you're applying from, the amount that you're putting on there, and also the industry, because there's also industry averages that they're playing off of. But I want to take this a step further because remember, 99.9% of the time, you're going to be personally guaranteeing this debt. And so they're going to be taking a look at your personal credit lines. So if you put on there, hey, we're going to be generating $500,000 a year, it's your first year in business. Banks aren't dumb. They're going to take a look at, wait a minute, what credit lines do you currently have? Okay, your highest credit line is let's say $2,000. The vehicle that you got approved for, which let's say an $8,000 vehicle, that's not a big credit limit. And so banks are going to take a look at that information and then they're going to make a guesstimated decision on the spot right there. If that number is way off from where the average typically is based off of a tier system, bam, it's getting kicked back altogether. And in some instances, if they feel like the person is fishing for credit, they could just blacklist them from the bank altogether. You want to be very watchful of this, which is why I'm giving you this information. Another way put, banks are going to look at both the macro and the microeconomics of each and every single applicant. Next up, you have applying for too many accounts too quickly. Now, this applies to both personal and business accounts. Now, banks are going to be able to take a look at how many accounts you apply for, both internally and externally. Most of the time, they're able to see this off of two metrics. Number one is they're able to see this off of the hard inquiries that are reporting on your credit. But the second way that they're able to see this is you have what's known as internal underwriting, and then you have what's known as universal or external underwriting. Here's what that means. If you are applying at Chase and you go to Bank of America, each of them have their own underwriting systems, but each of them can tell whether you applied for that bank or not for a credit line based off of the hard inquiry. That's on the external underwriting. Internal network underwriting works a little bit differently because sometimes banks all underwrite using the same third-party company. Some of them could be TCM, some of them could be using the FNBO network, some of them can be using Elon Financial Services. So what that means is you may think that you are applying at 3 or 4 different banks, but you're still landing inside of that same application pool. And so if you're wondering, man, I applied at 4 different banks, I got denied instantly, you have to ask and you have to find out, okay, is this the same network or are they being underwritten by third-party companies? Number 8, and this was personally a big aha moment for me because I always wondered about this and, I always had my conspiracies about what to put, but there are certain answers that are going to trigger kind of like the red flags and the bells are going to go off with the bank. And so if you've ever seen an application where, it's going to ask you, do you want to pay off debts? Do you want to debt consolidate? Is it a big future purchase? Are you remodeling your home? Those are questions, and it's almost like Tripwire. Anytime someone's ever put, I want to pay off a student loan with this loan, or I want to consolidate my debt, I've always seen that as a Tripwire. You'll usually get an automatic denial, or let's say if you could have gotten approved for 30K, you get approved for 5K. So upon speaking to some of these lenders, they've noticed, or at least I've noticed from kind of like reading in between the lines, if you're going to put that you're going to be making a big future purchase using those funds, then that usually edges your way into getting an approval versus using one of the other methods, which again, if you're using maybe a personal loan or even on the business loan to debt consolidate, that to me is Tripwire written all over it. I usually advise my clients, you're gonna have some better options if you just go to a debt consolidation company, if that's what you wanna do. But putting that on those applications, it's just a dead deal. And lastly, similar to internal and external or universal underwriting, you have internal and universal bank account balances. In a nutshell, what this means is that banks want to know how much financing or how much funding, rather, capital you have readily available with them in that account. We know this, or we call this typically liquid heavy. A lot of banks are liquidity based, which means that they want to see more funds available in that account, which means that they can use it to lend out to more people, right? It's velocity banking. Now, when it comes to universal bank accounts, they can also take a glimpse at this. A lot of banks communicate externally within each other. And so if you're blacklisted at one bank, especially if you've been blacklisted at Amex, odds are that may potentially carry over into Chase. And so you want to be really careful with that. So that's why you never want to go negative too long in an account, if at all. Look, if I'm being real with you, you never want to go negative. If you, for whatever reason, forgot to make a deposit, bring it out of the negative account as fast as possible because it's like a domino effect. Once one bank account gets shut down, you'll start seeing other bank accounts start getting shut down either for potential merchant fraud, if you have too many chargebacks, or if you are maybe not keeping enough money or funds in those accounts altogether. So there you have it. Those are some secret tips that I want to share with you that I picked up from some of the underwriters and some of the bankers and some of the biggest lending institutions across the country. If you found value in this video, consider sharing it with someone that you know is looking to take their banking to the next level. But other than that, I appreciate each and every single one of you guys. I will see you in the next video. Peace.